Welcome back. You're watching Stock Watch with me, Nader, and joining me to unpack your stock-related questions tonight are Nader from Benguela Global Fund Managers and Devin Shutte from the Rebay Group. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gentlemen. Quite interesting moves that we saw on the JSE, and I actually want to zoom into the resource stocks because we did get some numbers out from BHP and Kumba Iron Ore, and I'm not exactly sure if those share prices just followed the sour sentiment in that resource sector or if they were linked to those numbers. Let's actually start off with you, Devin. What did you make of the kind of general pressure that we saw on the JSE today, but also particularly on the resource sector?
Sure. I mean, commodity prices were under some pressure. I think a lot of that can be attributable to let's call it the disappointment in China. Their government, they're really trying to stimulate their economy and cutting the prime rate there. But yeah, not maybe having the effect on the day that markets would like. Yeah, so as you said, some very stock specific results. You know, if you look at a more domestic manufacturer like Kumba, they really bemoan the kind of lost opportunities that came from our, you know, very well documented issues that we have with logistics and with energy there. Yeah, and I think globally the picture to me looks like demand might be softening somewhat, particularly with the big consumer China kind of hiccuping a little bit. So that probably filtered through into our market and into the various counters. Yeah,
I will ask about those specific numbers, but I just want to say that, I mean, with Kumba, the challenges are so deep that obviously they've had to now cut back on production, where now they're saying that they have to cut jobs. And we also got the same announcement from Amplats. And today we actually got fourth quarter unemployment numbers, Grant, where we did see a tick up. Is the unemployment figure going to remain under pressure as long as we have these structural issues where we're constantly scoring own goals?
Well, it's a great question, and unfortunately, this unemployment number is a bit of a disappointment because we've actually had a good trend of job creation over the past couple of years. Even we've been trying to recover to pre-2019 levels, and we've almost got there. So we don't want to see this trend start to reverse. But if you just listen to the news, listen to the companies, there's definitely a lot more talk about restructuring, right-sizing. You can call it what you like, retrenchments, job cuts, etc. coming. And of course, we're still heavily dependent on commodities for employment. And if this commodity sector as a whole continues to remain under so much pressure, I can't see how we're going to continue to grow meaningfully in the job space. So I think it is a concern, and you know, we'd like to see some recovery in these commodities, but if nothing else, a stabilization. You know, it's very difficult for companies to plan expansion and to employ new people if they have no visibility or comfort that they're still going to receive the prices that they see on today. So so it's all it's a bit of a moving target at the moment. And as Devin said, we need China to come to the party, or alternatively, we need the dollar to weaken, and that would actually be quite a nice catalyst for commodities potentially. So we'll have to look and see how that plays out.
Yeah, I mean, just sticking with Kumba Iron Ore, because a lot of what leads investors to plow into these stocks are usually the prices, and we're talking about the prices recovering. And of course, as much as there are these operational challenges that are affecting production and jobs, you know, that is the cutting of jobs is one of the strategies that it's using to kind of make the company more competitive. You know, as much as this is very bad news, but does this maybe make more Kumba Iron Ore maybe a little bit more investable because of the strategy, but also the high iron ore prices, Devin?
Yes, I think so. You know, any time a company is trying to improve its internal efficiencies, that's generally good. And you know, as you've mentioned, Amplats as well, both companies are looking to you know quite aggressively bring down those those operational expenses. I mean, they're doing it through reducing labor forces, they're doing it through reducing the number of suppliers they use, and through internal efficiencies, and all those things from a company perspective can be positive, but there gets a point where you cut too close to the bone and it actually starts to have a negative effect on the company, you know, notwithstanding the human cost of job losses. So you know, while we would applaud internal efficiencies, and these big companies generally have some room to create those, there is a point where it starts to hurt. But I'm not sure we're there yet. I mean, those Kumba results, you know, look pretty handy. I mean, you know, I mentioned logistics hurting them, but you know, they had a nice increase in EBIT margin. They managed to up the divvy a bit. HEPS was growing in the mid-20s. So I think overall not bad. But what you don't want is this really, as Grant mentioned, sustainably negative environment that these companies have to try eke a profit out of.
Yeah. Well, a company that seems more upbeat is BHP. They also released their numbers today. It seemed that obviously, as much as we saw headline earnings going down, that it did beat on what analysts had anticipated, even on that dividend there, seeming that they're more upbeat on the inflationary picture and what they could produce, you know, in the future. Grant, would you say that BHP is one to get optimistic about at this point?
Yeah, first of all, I will just add that I think Kumba is actually one of those that's doing particularly well in this environment, and the iron ore price has held up incredibly well, different from some of the other commodities. BHP remains one of the best quality, if not the best quality, of the general miners. And yes, they've had some serious write-downs on their nickel operations. They've got this pending fine that's causing some uncertainty, you know, in South America. That's just been extended. That could be 6.5 billion that they're going to pay out. So they've got some uncertainties, but their broad strategy is very much intact. They are very good at their capital allocation traditionally. They've got a good portfolio of metals. So yeah, I think BHP is steady as she goes, as you're going to get in commodities. So yeah, if you have to stick your toe in the water, this is probably the safest one, the safest way to step into the water at this stage.
Yeah. Would you see BHP also as a safe option at this point, Devin?
Yeah, maybe safer than a single commodity producer. Okay. And yeah, we like the diversified miners, and BHP is, yeah, we'd also think the top of the pick there. You know, we really like the copper assets. We think there's a big runway there. Potash is also looking increasingly interesting. So yeah, just a proven track record of capital allocation, and yeah, one we were happy with today.
All right. Well, let's go over the seas. There's a question on cybersecurity stocks here. I have a spread on of NYSE shares. They have really done well in the past year. I'm weighed to these two shares, and that is CrowdStrike and Palo Alto, and they have literally doubled. Do I need to take profit, or as a long-term investor, should I rather weigh the ups and downs, keep my focus and let it ride? Seems the cybersecurity is on a roll. I'm thinking this sector will always be strong. Grant, Palo Alto, CrowdStrike, cybersecurity, would you be taking your profits, or would you be going with the ride, seeming that it is quite strong at the moment?
So I think there's a couple of questions in there. First of all, cybersecurity is definitely a space you would like to have exposure to. Let's face it, data is the new gold or the new oil. It's only getting more important, and at the same time, therefore, cybersecurity is getting more important. It is a structural, long-term demand factor that's playing out, and it's not going to go away. In fact, the risk is getting higher as we see generative AI roll out. So the demand is there. The growth is there for the industry. The question is, what companies do you own? Palo Alto is definitely one of the best players. It's one of the few profitable players as well. It's been around one of the longest as well, but it isn't cheap, and none of these stocks are cheap. I think Palo Alto is at about 70 times forward earnings, but you know, your growth rate sort of unwinds quite quickly in these companies. So CrowdStrike, I don't think is positive earnings yet, but they're reinvesting at such a furious rate for the growth in front of them. So you just need to understand that. I think, you know, would I hold on to it with a 5 or 10 year view? Absolutely. With a 6 month view, it's hard to know. The markets are volatile, and these particular stocks are highly volatile given the nature of their multiples or their valuations and the way they trade. Remember, though, it must be the right size in your portfolio. You don't have to sell all of it. You could always take some profit, right size the positions a little bit so you can sleep at night and then hold it for that long term, 5 years, 10 years, because we all say long term until the market drops 30%, and then suddenly the long term story goes out the window.
Yeah.
So get the position sizing right, but I think you should try and maintain some long-term exposure to the sector, and those are two very good companies in the space.
Yeah, because also what stood out for me from the viewers that I'm thinking the sector will always be strong. But the sector can be strong, but the share price not all the time, Devin.
Absolutely.
Devin, yeah.
I mean, this is such a fascinating and topical sector at the moment. I think often good companies don't always translate into good investments. I know the viewer already owns these two, and I'd agree with Grant. Cybersecurity is a massive growth industry. I think we've got to look back a little further than the last 12 months to see what US tech has done. I mean, if you just look another 12 months before that, we're basically back where we started, right? So 2022 was a shocker, and 2023 we made back most of those losses. And I think both these companies are probably in a similar space. So yeah, I think what you pay for an asset does count in the long term. I think these are compelling business models, but I think you've just got to be very cautious of paying any price for future growth. I think you've got to be very circumspect as to what could happen to these counters should we get another shock in markets, another geopolitical risk, interest rates stay high for longer, any number of variables, election outcomes that we've spoken about. So yeah, I think when you're paying up for companies, you have less safety in that, and so I'm just advising caution, notwithstanding the actual companies themselves.
There is a question on why Stockwatch is not being aired as a podcast on Spotify and Iono. I will definitely get back to you as soon as I can. Now on to the questions. We were talking about Capitec. I did promise you a question on Capitec after the break. Is Capitec a buy at current levels to keep over the short to medium term? Of course, for the longest time, Capitec was a hold or a sell and not a buy. But I don't know, Devin, have things changed?
No, I'm not sure. And again, when are you buying this? I mean, Capitec has really done incredibly well for shareholders through the years. I mean, they've built up that client base to I think it's around 20 million customers at the moment. So that is fantastic. I would argue that the growth story looks like it's almost invariably going to slow. I think the weak macro surrounding the company is not going to help, and I think credit healthiness within the book they have, a lot of which is unsecured, is always a risk there. They've managed it well to date, so I'm not saying I'm expecting huge problems on the horizon, but I just think it's going to be tough going for a while. So to the viewer's question, would I be deploying new capital into Capitec? I'd be pretty cautious on that. I think the kind of more traditional banks are offering a lot more value at this stage. I think they're better positioned, and valuations are looking a lot more attractive, and not to mention really juicy dividend yields.
Grant, would you be buying, selling, or holding at this point?
I would buy some. I think it's a good enough company. In fact, it's one of the highest quality businesses on the exchange. And if you're managing your own portfolio and you've got a long-term timeline, it's one of the companies you need in your portfolio. Don't pile in at this level. Yes, it's a little bit. It's had a decent move, but they've got some growth vectors that other banks don't have. They're taking market share. They're moving into business banking. They're moving into insurance, and they've got the most incredible distribution channel. And their return on equity is superior to anyone else in the market. They've got growth none of the other banks have got. So yes, the other banks offer more value if you're looking at a valuation basis, but they don't offer the same growth and the same upside potential either, and the long-term ability to compound at higher rates. So personally, I like it. I would buy, if I was going to buy 100, I would buy maybe half here, or I would ease into it because the market is going to be volatile this year, most likely. But it's a company I'd like to have in a portfolio. at all times if it's a long-term perspective.
All right. Well, as we're talking about banks, you guys also did mention that the other banks seem to be cheaper. So your view on Standard Bank at the current levels, also keeping in mind that earnings are coming next month, Devin.
Yes, Standard Bank, one we like. I think the domestic operations have been fairly solid. They've managed those non-performing loans well in a higher rate environment. I think what we've really been pleased with is the African operations and the branch network there really showing some nice growth. And so I think you get good geographic diversification in a consistent player. Not stretched from a valuation perspective, and payout ratio on the dividend looking really healthy.
Grant, I think from what you said, I think you would agree with a Standard Bank as well. So I'm going to ask you about MTN. If MTN cannot get their money out of Nigeria, why would it still be investable?
Yeah, that is exactly the question. That's the risk around that share. And every time they're resetting that currency to find liquidity, they still haven't found that clearing price where there's good two-way flow in dollars and naira. So it's a genuine risk, and I mean at some point it may well clear, but the problem is MTN's actually it's such a big chunk of their business. This is not a small part of the business in Nigeria. It's at one stage it was 50% of the business. I'm not sure what it is now. So the Nigerian operation, you can't just ignore it. It is way too big, and if you can't get your money out, that money is no good to you as a shareholder. So you need some line of sight as to how and when. They're going through a painful restructuring of that economy. It may take a couple of years. Ultimately, the long term, they are doing the right things, but the path to that end point is painful. It's unclear, and yeah, I think MTN is going to continue to struggle to clear that money, to downstream it. And yeah, for me, I would stay away from MTN at this point in time.
Yeah, and actually, does it seem like there's much more correlation now with the MTN share price compared to with the naira, and it just seems like the challenges are starting to really filter through to MTN more significantly at this point, Devin?
I haven't looked at that correlation, but I would think it must be there in some degree. Yeah, I just, it's been a perennial underperformer, and I say it really has gone into these frontier territories, and unfortunately, despite the growth potential that existed in operationally and on the ground, and the upstreaming of capital has just proved to be incredibly difficult, dealing with regulators, dealing with central banks, and yeah, it's not one I'm rushing into either at the moment.
All right. Well, let's chat about transaction capital. It closed today at 9 Rand 10. What is better, to sell at the current price and then buy cars as soon as listed, or wait, Grant?
So we haven't done a valuation on We Buy Cars. I don't know what the value unlock will be. Remember though, if you hold transaction capital into the listing, you're still left with transaction capital as well as your We Buy Car shares. So you need a view on that business as well. I'm not quite sure what will be left. That's not a great core that you're left with outside of the We Buy Cars business. So depending on where you bought it, I mean, you could have bought this company at 5-6 Rand, I think, as low as that. So if you bought it below 6, 7, 8, and it's at 9.90, take some money off the table. I think so. And then you can have a look at We Buy Cars. I don't have the numbers in terms of valuation, so I think We Buy Cars could be a good business from what I've seen. Interesting, but I don't know what's baked into the valuation at this point with transaction capital.
I don't want to sell because I got 17 Rand. Devin, what would you? Yeah, what would you be considering at this point if you had transaction capital? Sell at current price and then buy We Buy Cars, or wait to see what happens?
Look, I mean, it's they're very difficult decisions if you're in there at 17s and 90. I think the We Buy Cars is definitely the attractive asset. Newton has actually performed quite well, but obviously the millstone around the neck of transaction capital has been SA Taxi, and that still looks like it's in for a tough old time. They're doing a few things. They're trying to restructure the debt. There's been huge management changes, so could they right the ship? possibly, but yeah, I mean, I think if you're in, you're probably in for a penny, in for a pound, but I think new capital, you definitely wait. And yeah, depending on the valuation, We Buy Cars is probably one to enter separately.
All right. Well, back to mining. On Thungela and Exxaro, is the commodity sector coal a good entry considering possible day zero to Sasol industrial gas line? I'm not sure if this is something that you've thought about in terms of investing in coal, Grant?
So I think the question is saying, as the gas, Mozambique cuts off the gas in 2026, will that improve demand for coal? Is that the question I'm hearing? If that's the question, coal prices are not really set by Sasol's demand. They're more sort of globally benchmarked. I'm not sure that, well, that for me wouldn't be a reason to own those assets. I think coal prices are more generally tied to the economic outlook and the global slowdown, etc., and oil. Yeah, I think it's a different question. Would I buy Exxaro or Thungela here?
Yeah.
Potentially they look interesting, but you need a strong view on the cycle for coal. Where are we in that commodity cycle? It's not clear to me that we're at the extreme lows. It may be the lows, but with commodities, you never know. So you always need to have that. You need to be circumspect and perhaps just conservative when you buy and how you phase in your buying in these commodities.
Yeah, indeed, because I mean, even as we saw with BHP, coal was the underperformer. Devin, prospects on coal, and if you'd be going into Thungela and Exxaro at this point?
Not to be a cop-out, but, you know, as I mentioned earlier, single commodity producers are inherently, let's call them cyclical, not volatile, and, you know, calling when to get in is very difficult. I think in terms of a view on coal, I'm similar to Grant there. We're probably near the bottom of the cycle. Where exactly is impossible to say. I will say that it's likely that coal will remain a dominant part of our energy mix in South Africa for quite a while to come. And, you know, as we continue to produce more power and our fleet maybe gets refitted, I think there's going to be an increasing demand for it. But bringing it back to those two companies, I think there's still a lot of uncertainties, and I'm not rushing into it is probably my conclusion.
All right. I'm giving you both an ETF before we go to your stock picks. Grant, you the Signia UK FTSE 100 ETF, and you Devin the Signia Fang AI. So on the FTSE ETF, great companies spread throughout Europe, and as a bonus, it pays out good dividends twice a year. Is this ETF the one to go for or not? Or would you be going for another ETF, Grant?
I think it's not a bad one to have. Again, I would say with ETFs, don't have one, have a few building blocks. And the FTSE one is a good one. FTSE is offering a lot of value. In fact, it's quite cheap relative to Europe and other markets. It's quite commodity or resource heavy and also healthcare heavy. So you need to understand it's a very different mix to what you'll get in the US or some other global economies. But so having said that, it provides a nice block. I wouldn't put my entire 100 Rand into that specific ETF, but I'd perhaps put 20 or 30% of my allocation into that and then build some other exposures around that. Because it has a different kind of profile in terms of its growth levers versus some of the other indices around the world.
All right. Quickly, Devin, Signia Fang AI, composed of companies found in the S&P 500. Would you rather invest in an S&P 500 ETF or the Signia Fang AI?
Look, Sonati, we've been looking at this a lot, and I guess it kind of comes back to the earlier point I was making in terms of chasing very highly valued and popular stocks. We think that works till it doesn't, and I mean, I know that sounds obvious, but it can end in tears. We think an option to look at, not maybe going for the S&P 500 market cap weighted, but looking at the equally weighted S&P 500, which has traditionally outperformed the market cap weighted index over many decades. It hasn't recently, of course, with the Magnificent Seven, but that could be a very nice play for investors wanting to get exposure to large cap US equity that's not overly concentrated in the big, what I would argue, expensive tech names are.
All right. Well, 20 seconds for each of you. Your stock picks, Grant, what will it be?
I pick Evolution Gaming, a European-based company that runs online casinos, live casino games, and they're B2B, so they actually operate on behalf of end-user casinos all around the world. They've got exposure in the US, Europe. They're one of the largest players in the world. Great little company, incredible free cash flow, ridiculous margins, and it's just a good business with high quality cash flow and decent moat. So that's Evolution Gaming. That's my pick in 20 seconds.
All right. Devin, on your side.
Mine's an ETF, Zanati, and it comes with a strong health warning and should be sized appropriately, but it's the CSI China Internet ETF, code KWEB. And this is a basket of Chinese tech stocks. So in there you've got Alibaba, NetEase, Tencent, JD, and the like. And all these companies have significant amount of cash on their balance sheets, but investor sentiment's just been incredibly pessimistic towards China for some valid reasons. So valuations are looking incredibly cheap. The outlook really does hinge on government policy, and we're starting to see some noises there, but we really need some big fiscal input. But you know, when you've got something, China's trading at 40% discount to its emerging market peers, it's the most uncorrelated market to the US. I think that the surprises could be to the upside, and I think Chinese tech stocks could lead that.
All right. Well, thank you so much for your time and for your insights today, gents. Appreciate it. That is all for tonight's Stock Watch. Thanks to our guest, Nader from Benguela Global Fund Managers and Devin Shutte from the Rebay Group. Up next, The Close. Stay watching.